Say you're a shareholder of a private company, and the company is doing really well and has retained earnings of $500,000. Last year, that is in FY 2020, you decided to take a loan out from the company of $500,000 to buy a boat. But of course, we all know that as a shareholder that borrows cash from a private company, that is caught under Division 7A. And so you decided to put the loan under complying terms, which means that you need to pay minimum yearly repayments every year, which includes minimum interest at the Division 7A benchmark rate and minimum principal repayments over a 7-year term. So this basically means you have to pay circa $85,000 principal and interest by 30 June 2021. But you already spent the money on the boat and you have no money to meet the minimum repayment. So, what are your options in terms of funding that minimum repayment? So, let's start off first with what you should not do. So, you should definitely not borrow more money from the company to repay that loan because that is not a genuine repayment. So that would be caught under Section 109R, which means that the repayment has not actually been made, and so there is still a shortfall of that minimum repayment, and that shortfall is deemed to be a dividend, which means that amount of 85K is an unfranked dividend, and so it means that you'll have to pay tax twice. Once by the company at circa, 26%, 30%, and another time by yourself as the individual at your personal marginal tax rate, which is potentially 47%, and you don't get a franking credit tax offset. So, here are a list of potential strategies for you to consider. Number one, the obvious option is, of course, to pay yourself a dividend from the company. So the company pays you a dividend of $85,000 on 30 June 2021, and you take the $85,000 and pay it back to the company. But of course, you can do this all via journal entry and proper documentation. But wait, that's not as simple as it sounds, right? You will be taxed on that $85,000, and so you got to make sure that you have sufficient cash to pay tax on that dividend. So the additional tax on this dividend after a franking credit tax offset is circa 20K. So start saving. But the great thing about this is that the tax is potentially only due on 15th of May 2022, so there is plenty of time. Regarding the timing of the dividend, it has to be paid by 30 June 2021. No, you cannot backdate this, and merely processing a journal entry will unlikely be sufficient to prove that the dividend was paid on 30 June. I'll make another video on how to properly offset dividends against minimum repayments, particularly in more complex situations where the immediate shareholder is not an individual but a trust, but where the loan is with an individual. But what if the company does not have any franking credits in order to pay out a franked dividend? And you may think that this doesn't actually make sense because if there's retained earnings, then there was taxable income in the past, and so tax would have been paid, and so there should be a pretty good franking account balance. But I've heard that because of the instant asset write-off, some companies have actually been getting huge tax refunds that are creating franking debits, and that's wiping out their franking account balances. Also, with the introduction of the loss carryback rules, which will start to kick in for the FY 2021 tax returns, when those refunds start to come in, you may find that in FY 2022, some companies may not have that much franking credits anymore, which is why I think it's important to explore different alternatives on how to fund those minimum repayments besides a franked dividend. So the first strategy is what I called the offset against credit loans in the company option. So first of all, you have to check if the company has borrowed money from you or any other entity within your private group. And so this would show up as a credit loan in the company. So for instance, say you had a discretionary trust and that trust invested in Bitcoin and sold it and made a whole heap of capital gains and cash, and the trust transferred some of that cash to your company for working capital, etc. So effectively, it's getting the company to pay back that loan to the trust, and say, coincidentally, that loan amount is $85,000. And then the trust lends you that $85,000, and then you take that $85,000 and pay the company back in respect of the Div 7A minimum repayment. And you can do this all via journal entry and proper documentation. So no cash actually needs to be exchanged. And just for the more advanced practitioners here, when the company repays $85,000 to the trust, that is not caught under Division 7A, because it is not a new loan, but rather it is a repayment of an existing loan. And therefore, when the trust lends you that $85,000, it is also not caught under Division 7A interposed entity rules, because it is merely a trust making a loan to an individual and has nothing to do with the private company. Of course, you have to make sure that the trust has not borrowed any funds from another private company, and that the trust does not have an unpaid present entitlement owing to the company. That is, the source of the funds is from the sale of the Bitcoin, and it is not indirectly sourced from a company. The next strategy is to pay you a bonus. So the company pays you a bonus as a director. And the tax consequences are that the company can claim a deduction on that bonus. But on the flip side, you would need to pay tax on that salary/bonus at your marginal tax rate. So this strategy will be more effective if you are on a lower marginal tax rate. But if you're on a high marginal tax rate, as I said before, the tax on this is potentially only due on 15th of May 2022. So this strategy is much more effective than paying an unfranked dividend, because the company gets to claim a tax deduction for the salary/the bonus. Whereas if the company pays an unfranked dividend, this is not deductible for the company, and the company has actually already paid tax on this on the profit in relation to that dividend. And you as a shareholder needs to pay tax again on the full dividend amount, but you need to make sure that the director's salary or bonus paid to you commensurates with market value. Otherwise, Division 7, Section 109 may apply to deem the salary as a dividend and not deductible in the hands of the company. So check it out, Division 7, Section 109, excessive payments to shareholders, directors, and associates deemed to be dividends. In working out if this strategy is effective for you, make sure you also take into account other on-costs of paying that bonus, such as payroll tax and superannuation.